Being financially free doesn't mean quitting your job or becoming a millionaire. It's about being confident and in control of your money so you can spend on the things that you love today, whilst investing and planning for the future. Achieving financial freedom is simpler than you think. It's taking action today and applying it consistently over a long period of time. In this video, I will share with you 5 easy strategies that if you get them right, they will help you achieve your financial goals and build a life that you truly love. Hi, I'm Sabina. I'm a chartered certified accountant with diverse experience gained at one of the top UK accountancy firms and in the industry. On this channel, I share knowledge and strategies about finance, entrepreneurship, and self-development to help you achieve your financial goals and build a life you truly love. Step number 1 is track your money. The key to be in control of your money is to understand your current situation and where your money goes. You can start by analyzing your bank statement and allocating all your money that you received and that you spend. In the income section, you want to allocate your employment income, self-employment income, or investment income such as dividends or rent. You want to categorize your expenses into 3 categories: fun, fundamental, and future you. In a fundamental category, you want to allocate all the money that you spend on your core living expenses, your non-negotiables, such as your mortgage, rent, transportation, groceries, utilities. In the fun category, you want to allocate all the amounts that you spend on savings and investments into the life that you envisage further down the line. In a fun category, you want to allocate any amounts that you spend on things that enhance your life now and make your life more enjoyable and fun. Things such as entertainment, subscriptions, gym membership, traveling, or experiences. I have a video where I go into details about these with the free payday manager. If you would like to check that out, I will have it linked in the description below. Good money management is finding balance between investing and planning for the future and spending on things that you love today. For example, if your goal is financial freedom, but you're spending money on a big house or expensive car that take up most of your income, that keeps you away from achieving your goal, which is financial independence. Step 2, build up your emergency fund. 39% of people in the UK and 49% of people in America have 1,000 or less in their year savings. Emergency fund is a safety net for any big unexpected expenses such as job loss, unexpected medical bill, house or car repair. It gives you psychological comfort and a peace of mind. Start by saving 1 to 3 months of your fundamental core living expenses, so in case something goes wrong, you can deal with the emergency itself and don't worry how you're gonna pay for it. Then you can increase those savings to 3 to 6 months of your core living expenses for extra security. Or if you are self-employed in unstable job or high risk industry, you can aim for 9 to 12 months. You want to keep these funds in easy to access and high interest saving account so your money is working for you and you're earning interest. Step 3, repay high interest debt. You want to list all your debts with the interest of 8% and higher, and then you want to choose your repayment method. Here we have a snowball method and avalanche method. With the snowball method, you repay the loans with the smallest principal first, so that way you get quick wins. With the avalanche method, you repay the loans with the highest interest rate first, And although it's less rewarding than the snowball method, it is the most financially optimal way to repay your high interest debt. When deciding how much money to save in your emergency fund versus repaying the high interest debt, you might want to consider the fact that that costs you more than savings. So what I mean by that is 1,000 on your credit card with 20% interest versus 1,000 in your saving account with 5% interest makes you 150 worse off than if you use that money to repay your high interest debt. Step 4. Invest. You want to invest in yourself first and learn skills and knowledge that will increase your personal value, so it will help you get where you want to be faster. If you are employed, there is a limit to how much you can earn and therefore how much you can save, because your employer pays you certain market rate for the skills that you have. So you want to improve your earning potential by increasing your skill set. That way you can ask for a pay rise or apply for a better paid job. Warren Buffett, one of the most successful investors in America, once said that the best investment you can make is in yourself. Next, you want to invest in assets that increase in value over time. These are real estate or stock and shares. The earlier you start, the more you benefit from compounding growth. So, for example, if you're 30 and you're contributing $500 every month for the next 20 years with 8% return on your investment, your total contributions by the time you're 50 will be 120,000. Your investment growth would be 166,330, and the total value of your investment at the end of 20 years would be 286,330. Next is the employer retirement match. So if your employer offers to match the contributions that you make towards your retirement, it means they're giving you free money to invest for your future. The way it works is that every contribution that you make up to a certain percentage, your employer matches that. For example, if you're contributing 5% of your salary, your employer will double that by adding another 5%. Second benefit is that your pension contributions are deducted from your salary before tax, which means that they're reducing your taxable income, so you pay less tax and have more money left in your pocket. Finally, you want to take advantage of a tax-free investment accounts, such as ISA if you're in the UK, or Roth IRA if you're in US, so that your money grows without you paying tax on your profits or your gains. Step 5. Manage and review. Every 6 to 12 months, you want to review your finances to make sure you're keeping your costs under control and you're increasing your investments and savings. You want to analyze your investments and evaluate your portfolio to make sure it's in line with your risk appetite and the life you envisage in the next 5 or 10 years. That's it. That's my 5 easy strategies to manage your money. If you found this video helpful, please let me know in the comments below, and I would appreciate if you subscribe to my channel. If you found this video helpful, you might also like this video where I give you a free payday manager template and walk you step by step how I categorize my expenses. See you there.